Hey, welcome back. I'm Rick Harrison, and in this week's Southwest Florida housing market update, I'm going to go over the latest data, inventory levels, and trends in the housing market, as well as the major economic news that will affect your decisions going forward. That's all coming up right here. Hey, thanks for joining me today. I'm Rick Harrison with MVP Realty in Southwest Florida, and on this channel, I bring you the latest market news so you can make better decisions when it comes to buying, selling, and investing in Southwest Florida real estate. If you're new to the channel, welcome, and if you haven't already done so, please consider subscribing and hitting that bell so you don't miss out on the latest data, tips, and news keeping you ahead of the market trends. All right, so I'm sorry this is a late one this week. I've already recorded this 3 times already, and I'm starting to lose my voice actually. So I'm doing this a 4th time so I can actually get it. I figured out the kinks in the system. So I wanted to bring you this update, even though it's a little bit late, because there's been a lot of stuff that's really been changing over the last 2 weeks, more especially over the last week. And I'm really excited to bring this news to you this week, especially for you buyers who have been sitting on the sidelines, because things are really starting to shape up in your favor. We're going to see a lot of headlines today. We're also going to hear from 2 experts who talk about some stuff that really is going to have a huge impact on the economy as a whole, which is going to trickle down into the housing market. But it's something that isn't covered by mainstream media too much. And I wanted to make sure you guys know about it and how it can affect the housing market and the economy overall. So without further ado, let's dive right in, and we're going to go over the local market update. Just to give you kind of an idea of what's coming up, we have home builder sentiment falling, yield curve inversion is deepening, home buyer competition drops to the lowest level in 2 years, prices are beginning to fall, supply is up for the first time, and HELOCs, I'm going to touch on that at the end very briefly, and give you a couple resources to go check out at the end. But without further ado, let's move right on into the local stats and inventory updates. So I'm going to remove myself here, but the first one, for those of you that are new to the channel, the first section I'm going to do is the southern part of Southwest Florida. So this is from Cape Coral on to Naples, and then after this, I will cover from Port Charlotte all the way up to Sarasota. So this first one we're looking at, Cape Coral and Naples, new listings went from 811 down to 757. So that's down 7%. And despite it being down 7%, we also we did see inventory actually increase again week over week. So that's good news. Solds went from 680 to 658. Keep in mind, solds are what has happened in the past over 30 to 45 days or more. So this is a lagging indicator and not indicative of what's going on in the market currently. That's down 4%. Pendings were up 3%. That went from 723 to 749. And I think the big reason here, you're going to see this in both sections of Southwest Florida, but I think pendings went up because of the fact that mortgage interest rates actually declined over the last 2 weeks. We were up at almost 6% at one point in time, and now we're hovering in between 5.5 to 5.75% percentage. So I think that's why we saw a little bit of people taking advantage of the lower interest rates the last 2 weeks and trying to lock them in. Price decreases, 872 last week, which was an all-time high, went down to 835 this week. So still very high. If you go back to February and January, you'll see that we were in the 100s. I think it was around 160 to 180 was where we were seeing price decreases, which we're way up. We're up almost 4 or 5 times now. So let's go on to the inventory breakdown. Single families went from 4689 to 4800, so that's up 111. Condos, which is everything else other than single families, that went from 2088 to 2083. That just went down 5. So we had a net gain of 235 last week. And this week we have a net gain of 106. So we're still seeing more inventory come on the market than is going under contract or being sold. Multifamilies went from 184 to 177. That's down 7. But still, the story here is that if you go back to January, February, we were at 60. So this is almost 3 times the amount of inventory for multifamilies on the market now than we've seen over the last 5-6 months. Foreclosures, same thing we've been seeing. 50 went down to 48, so that's down 2. But also consider that back in January, February, foreclosures were way down. So they've actually doubled since then. So that's good news. And I think we will see more foreclosures start to come on the market now that we're kind of getting away from all the craziness that was going on before. All right, second section, the northern part, Punta Gorda to Sarasota. New listings went from 2056 to 2139. That's up 4%. So that's good news for that area. That's a new. That area really hasn't seen a whole lot of new listings coming on the market as much as the southern part, but now we are starting to see more of those go up. Solds, again, a lagging indicator, 1553 to 1767. So that was a lot of homes that finally were under contract and finally sold. That was up 14%. Again, that is a lagging indicator. That's what has happened 1 to 2 months ago. But the pending here, this is where the real story is. Pending's 1957 and 1976, really not up much, 1%. So that's really the indication of what's going on in the market now and where the sentiment is. Despite interest rates declining, this area didn't see much of an increase in pendings. But again, if you look at the price decreases, 2378 to 2389, that did go up slightly. But if you look in comparison to new listings and pendings, 2389, that's way up. That's above anything else. So more homes are being reduced in price than new listings are coming on, and then pendings are going off. So that's pretty incredible. Also, inventory breakdown for here. Now I finally do have comparisons week over week. So 3453 last week, that's up to 3652 this week. That's almost 200 new listings on the market for single families. Condos, 1271 to 1307. Again, that's a 36 unit increase. I don't have a net gain for last week because this is the first week of comparisons week over week, but the net gain this week is 235 compared to last week. Multifamilies, 139 down to 76, so that's negative 63. And foreclosures went from 221 to 127, almost in half, down 94. Again, I think this has to do more with the area. The northern part of Southwest Florida is very popular for investments. It's close to Tampa. It's close to Orlando. So a lot more investors are in that area. And I think that is why we're seeing a lot of the multifamilies go off the market as well as the foreclosures. Investors are still looking for properties. Florida's a hot place and they want to buy. So those are going to be some of the best deals and best cash flows that you can get right now. Interest rates. This was for Monday, 7/19. 5.699 last week. It went down a little bit to 5.475 this week. So again, that is why I think we saw a little bit of a rush to the pendings. Bank rate had it going from 5.75 to 5.73. We'll get into the wall of worry afterwards, but as of right now, I just want to kind of touch on the stories of the day. So we're going to take a look at some stories that the first two are really going to be, we're going to hear from what the articles have to say, and then we're also going to go into what some of the experts are having to say and what their thoughts are on the market now. So the first one is from the Florida Realtors Association. June single-family housing starts drop 8.1%. So this goes back to new construction and new home builders. The sentiment has been falling for quite a while now, a couple months, but it's getting down there now. So now it's getting back to the levels of 2007. So just to give you kind of a point. Weakness in the single-family sector was partially lessened by a 10.3% rise in multifamily sector. So that kind of really outlines the whole gist of this story. Single families have decreased quite a bit, 8.1%, which is the slowest pace since June 2020. The sentiment dropped just because of high construction cost, interest rates, obviously, and the sentiment is based on a survey of builders. So a lot of the builders are reporting, and I've been mentioning this for a couple of weeks now, are reporting weakening traffic as housing affordability declines. But on the other hand, multifamily market remains very strong. Actually, we're seeing more buildings go up for multifamily. I think this is, again, I think they're looking at lagging data and they're not seeing what's really going on in the market, which is why the sentiment's down, but they're still building a lot for multifamilies. With that being the case, Ivy Zellman, she said this, I don't know, probably 8 months ago. She said that she thinks that there is, even though we're supposedly down 1.6 or 1.8 million units, she thought that we were overbuilding back then. So that brings you to today, 6 to 8 months later. They're still building at a high rate, but now they're starting to slow down because they're getting pessimistic about the market. And we're going to hear that right from the horse's mouth. So overall permits, an indication of future building activity, decreased 0.6. However, permits For single families, we're down 8%, but multifamilies increased 11.5%. So that's really the story. But don't take it from me. Let's hear right from the CEO of the National Association of House Builders.
No better conversation to have than with Jerry Howard. You know him as the CEO of the National Association of Home Builders. And sir, I'm wondering sort of your key takeaway from this report, how you're reading it.
Well, the only way we can read it is that it looks like we're heading into a housing recession. And if that is indeed the case, it doesn't bode well for the economy as a whole. There's still some hope that things can turn around, but we're getting more and more pessimistic.
So that's right from the CEO. You know, as I've been saying, I think a lot of this is going to be dependent upon what the Fed does, and that's going to be the case. But what I see happening is the Fed is probably, like I said, the Fed is really not in control of the interest rates. They just chase the bond market. The bond market is really the one in control of the interest rates. So the fact that the 2-year and 10-year bonds have started to, it looks like they're starting to roll over a little bit. They have decreased over the last week or two, but they're still, they're still having some rallies. But what I think that's an indication of is the inflation. I think we're hitting peak inflation. Despite, prices will still keep going up, but peak inflation just means that it's not going to go up as fast as it has been. So if that is the case, I think the Fed will recognize that. I do think they're going to try for a 75 to 100 basis point hike this next go around. And I do think they're going to try to get another 50 to 75 basis points, at least one more in, to try to get back up to where the 2-year bond was. So it looks like they are kind of in control of the mortgage rates, interest rates, Fed rates, etc. But they're really not. So they're just chasing it. And you can tell that based on the charts if you want to take a look at those sometime. But other than that, I mean, I think the big thing is going to be if they do go through with that. If they do end up getting those 2 more rate hikes in, I think the economy is going to slow. The housing market's going to slow. The market's going to slow. There will be some, bear rallies still. But I think overall, what we're going to see is the Fed reversing course in the fall. I think the housing market is going to slow down so much that over the next 2 months, that mid to maybe late fall, we're going to start to see mortgage rates really start to decrease again. I think the Fed will probably start taking up a easy money policy again, where they start easing instead of tightening, continuing to tighten. But we will have to see what happens with that. Let's move right on to the next thing. This is the other big story that I really wanted to hit on. So this is the Treasury yield. So this goes back to the bond market. So for those of you who aren't familiar with the Treasury yields, basically you lend your money to the government in exchange for this bond. It's basically like a certificate, an IOU basically. When you do that, depending on how long you're lending them for, you expect a guaranteed interest rate back. So the shorter the duration that you're lending that money out for, you would expect a lower interest rate. So in this case, as you can see in the first 3 points, the 1 month, the 3 month, and the 1 year, you can see that's exactly what happens. The interest rate is 1.89, then it goes to 2.47 for a 3 month, then for a 1 year, it's 3.1. Now this is that's what a actual yield curve should look like. It should be an increasing and incline on the, as you get further out. What an inversion is when it starts to go the other way, which is where you see from the 1 year to the 2 year, it starts to flatten. And then from the 2 year to the 3 year, it actually declines. So the 2 year is only getting 3.17, the 3 years getting 3.14, and it keeps going down to the 10 year. Then the 20 year goes back up because that's way out in the future. And, it's not easy to tell. But then you got 30 years, and that's at 3.0. That's well below. So this is an inversion. And usually, I won't say it happens all the time, but most of the time, an inversion indicates a recession. However, the inversion in this case has started to get very deep now. So we're going to hear from Emil Kalinowski and Jeff Snyder, who run the Eurodollar University. It's a channel on YouTube. Definitely check them out. They cover a lot of data and information that isn't covered in mainstream media, and they do a lot of stats. So let's hear right from them what they're saying this inversion could mean.
The key takeaway from your article here is that it's not just a recession warning, right, Jeff? What's happening right now in the Eurodollar futures market seems to have transversed past the, hey, it's going to be a recession. It's concerning, Jeff, and you call it, let's see, the current curve is unprecedented in many respects. There's a 124 basis point inversion from peak to trough. That sounds like a lot. Is it a lot, Jeff?
That's an enormous amount. It really is. You think about, we were talking about the first, as you said, in the initial Eurodollar futures inversion on December 1st, 2021. And it was a basis point.
I remember.
It was a single basis point. And we were like,
we made a huge deal of it. I remember, Jeff. Wow. Now it's
because it was a big deal. As we say, anytime a curve gets out of its upward sloping shape, it should grab your attention because it should be upward sloping. It needs to be upward sloping. Upward sloping is beautiful. Upward sloping is optimistic. Upward sloping is normal. And so anytime a curve, even starting to flatten, I mean, we've been talking about flattening curves with alarm and any number of other words since last year. But then when we get to inversion is one of those things where you're like, okay, it takes an enormous amount of uncertainty, fear, whatever, to get a curve to go upside down, to get it out of its beautiful upward sloping shape into something so distorted, so ugly, that you have to look at it and say, even if it's just 1 basis point between two contracts on the curve, two directly adjacent contracts on the curve, just 1 basis point, that's something you have to pay attention to. Now, it's not earth-shattering. It's not, oh, my God, the end of the world. But it's saying something has gone from maybe there's a problem to, okay, there's now a problem. So if a 1 basis point inversion among two adjacent contracts is, okay, there's now a problem, what is a 124 basis point inversion across many contracts on the curve that makes the curve look at it? The shape right now is something I don't remember ever seeing in any past episode. So if we were concerned in December, what are we now in July? It's not just about recession. There's something else going on.
And that something else might be maybe another global financial crisis. I know I'm putting words in your mouth,
Yes.
Jeff, but this would be number 3 in the last 15 years. And in this,
that's the worry.
Sure.
That's the concern. If you're looking in the deep, dark recesses of what is downside risk actually mean, and I'm not saying it's going to be 2008-like, or even 2008 a repeat. We're never going to see a 2008 crisis again because the world moves on and the world changes. We're not going to see a rash of bank failures. Like there's not going to be another Lehman Brothers because banks, by and large, most of them have fortified their own balance sheets. The individual institutions will be fine, whereas the system as a whole suffers for the individual institutions fortifying their own balance sheet, which creates a different set of problems like those we experienced in March of 2020, which is what.
Well, I'm not going to go over the entire thing, but if you guys want to check it out, you feel free to. It's called Euro-Dollar Curve Inversion is Desperate and Deep. You can look that up. It's right at the bottom of the screen. But essentially what they're saying is that this could be some type of a potential global recession, not just the United States based, but this is something that's going on around the world. And I think we're all seeing that in the news based on, the war. You got China has a bunch of defaults and bank runs. You have, the Middle East has all kinds of turmoil and upheaval. It's happening everywhere. So it's not just here, but these are the things that we need to keep an eye on is what's going on. The inversion is a leading indicator of what is happening in the future. So if this continues to deepen, it could be an indication of how bad things could get. Not saying that they will, but how bad they could be getting in the future. Next one. So this is from Redfin, and this is just home buyer competition drops the lowest level in over 2 years. So for you buyers that have been sitting out there, this is great news for you. The bidding wars rate has dipped below 50% for the first time since the start of the pandemic in June. So what 49.9% offers written by agents face competition on a seasonally adjusted basis in June, and then 65% 1 year earlier and 57.3% 1 month earlier. So from 65%, from 57.3% just a month ago down to 50%, or actually just a little bit below. That's quite a bit. So as you can see from the graph for buyers, this graph is great because it's already down 50% in just a couple months. But for sellers, this is indication of the fact that you're probably not going to be getting as many bidding wars unless you're in a really highly desirable area. They still are happening. Excuse me. They still are happening, but not at the frequency and the rate that we were seeing, and people aren't bidding over asking, as high as they were before. All right, so moving on to the next one. This is also from Redfin. Prices begin to fall from record highs. Median sale price came down 0.7%, which doesn't sound like a lot, because it really isn't a whole lot. But keep in mind, this is a national average. So in certain places, it could be much lower. Certain places, it could be much higher. But as a national average, prices are starting to come down. So any market, really anything in life is cyclical. We all go through, everything goes through cycles. So that's your sine and your cosine, your waves, basically. So if you start to see something that's been going up on a steep projection for a long time, and then all of a sudden you start to see it go the other way, it might be flattening out, and it might go up a little bit here and there and flatten out, kind of like the markets do. But once it starts heading the other way, that's usually, we're heading into this next section of the cycle, which would be the downward cycle. And we have been, really for the last pretty much 12 years or so, or over a decade now, we've been in a great market. We've been in the bull run. Everything has been going up in price for over a decade. And usually every decade we have some kind of a fallback, but we kind of postponed that when the pandemic hit. Markets started crashing before the pandemic started. Then the pandemic hit, and that gave the government a reason to stimulate the economy, which really just kicked the can down the road. And I think now we're coming to the point where we're going to have to pay something. We're going to have to pay towards it somehow. So few people are able to afford homes costing 50% more than just 2 years ago in some areas. So homes are beginning to pile up on the market. And as a law of supply and demand, the more supply there is out there and the less demand, that causes prices to fall. Whether it's retail, whether it's houses, whether it's a stock market, that goes for everything. So now that we're seeing that beginning to pile up and the demand decreasing because of mortgage rates, and even if you have cash or you're a cash buyer or investor, I think the fact that interest rates are going up has a psychological effect on those cash buyers and investors as well. They're saying, hey, if everybody's holding off, maybe we should too, because maybe this thing is going to go the other way, where if we just wait a little while, we can kind of hold off and get something at a better price, and maybe rates will go down too. So that's the case there. Home buyer demand index was down 18% year over year, and mortgage purchase applications were also down 18% year over year from a year earlier. But if you take a look, seasonally adjusted index was down 4% week over week. So, you do the math on 4% week over week and you multiply that out through a year, it's way more than 18%. So if that trend does continue, I'd say we're probably going to see the prices come down a decent amount. All right, next story. This is also from Florida Realtors Association. Florida's housing market had more new listings, increased median home prices, and signs of easing supply constraints in June. So it's more specific to Florida. But the data trends indicate for sale inventory levels are beginning to rise, which I've been talking about for quite a while now. That's why real estate is considered local, because things could be happening in Texas and California that have nothing to do with our market here in Southwest Florida. So if you've been looking at, I know there's a lot of YouTubers out there that do based on the entire industry. You really want to focus in on local markets and find people who are talking about the local market, because the markets are all different. A lot of people are moving here. So if the case is that the market does change and go the other way, this could be an area where things aren't as good because they went up so high and, things didn't keep up with it. Last month, closed sales of single family homes statewide totaled 28,000, a little over 28,000. So that was down 17.2% year over year. That's quite a bit down. And then condo townhouses sales totaled just under 12,000. That was down 27% over June 2021, so a year ago. With that in mind, nearly 21% fewer existing single-family homes went under contract in June. So that's down almost 1/5, almost a quarter. So, right. So in combination with a 13.2% year-over-year increase in new listings, and you got less homes going under contract, you got an inversion there as well. So you got listings coming on and prices going down. It's going to be an indication of price going down in the future. This is really just a repeat, but I wanted it more for the graph. Home supply is up for the first time in nearly 3 years, but wanted to show you the graph because this kind of gives you an indication of where mainstream has been focused on the year over year. Well, prices are still going up. That's where you see the headlines. Prices are still going up. Yeah, it did go up 11.2% year over year, but what's going on right now in the current market is the month over month, and that's down. So median sales prices are now coming down, and when that starts to happen, a lot of times the psychological effect where it's like a race to the bottom. You want to sell your house, but the guy down the street's selling the same type of house, $20,000 less. Well, then you need to drop your price. And then all of a sudden he's, if he sells and somebody else comes on, they're going to drop their price. And then it's a race to the bottom. Same thing going on with new listings. Yes, year over year, we're down 4.4% because inventory has been decreasing, but now inventory is starting to go up. It's 0.1%. And these are national averages. So it doesn't take into account our market, which if you've been following my channel for the last couple of months, you've been getting the updates. Inventory has been increasing at a pretty steady clip. So we'll have to see if that continues. But the last thing I wanted to touch on was this is Steve Daria. He is a local, he's a local YouTuber as well, right in Southwest Florida. I believe he is in the Bonita area, but maybe moving, I think he was moving into the Fort Myers area. But anyways, he does a lot of local stuff, but more it's a lot of it's experiential and based on stories and experiences that he's had as a broker for, I think he's been doing it for like 15, 20 years now. Anyways, this video that he posted today, it's a short one. You should go check it out, but it talks about HELOCs. And if you're not familiar with that, it's an equity loan, basically. It's like refinancing your house, but it's to pull equity out. Essentially, it's taking a second mortgage on your home so you can get the cash out of the equity. A lot of people have been doing that over the last 2 years. Some of them, for personal use, but some of them also for investments. So if you think about the investor, they took the money out of their home. So not only did they decrease the equity in their house, depending on how much they did, they also took out a loan on it that they have to pay back. So that's their second mortgage. And then if they reinvested that into another property, now they have another mortgage. So that's 3 mortgages based on that one HELOC, right? So if prices decline enough, which I don't know if they will or not, but if they did, that could cause them, whoever that borrower was, to need to pay out a balloon payment to get back up to current with their first home, pay back their second home, their second mortgage, and if their investment property also lost money, they would need to pay a balloon payment on that as well. So that's a worst case scenario, and that's, I wouldn't say that's probable at this point in time, but that could be something that leads to more inventory coming to market later, along with the foreclosures. And remember, it takes upwards of 3 to 5 years in some cases for foreclosures to come to market in Florida specifically. We're one of the longest, one of the markets or states that has the longest processes for foreclosures to actually be closed down. So that's all really for this week as far as the news stories. But I did want to just touch on real quickly the wall of worry, because there are some changes this week and things to keep an eye on as we go forward. Fed, obviously, 100 basis point rate hike, and what they're going to be doing in the next, what it looks like they're going to be doing. Also the bonds. So keep an eye on the bond market, especially the 2-year. If you want to know where mortgage rates are going, just follow the 2-year, add 2.5% to that, and you'll get what the mortgage rates are going to be. So keep an eye on the bonds, because that's an indication of what the Fed's going to do. If it starts to go down, you're probably going to see the Fed reverse course pretty soon, which could indicate mortgage prices coming back, or mortgage rates coming back down. Also, we have earnings season coming up, and that could be indicative of more layoffs coming, depending on how these companies are doing in the, at the end of the first and second quarter. Also a lot of overstock. We heard about Target and a bunch of these other places that just, they overbought because of the demand. And now people are starting to hold off on buying stuff. Also, the strong dollar, something worth checking out. You can Google it, or you can look it up right on YouTube and watch a couple videos, and it'll explain exactly what the theory is. But it's the dollar milkshake theory. Basically the whole premise behind it is that instead of, you would think that the dollar would get weaker as we're decreasing its value, but instead what's happening is the dollar is getting stronger compared to other currencies, which is actually starting to collapse nations. We heard about Sri Lanka. We heard about now parts of India and other countries in that area in the Middle East. Europe is suffering. I mean, everyone is, because the dollar is the standard for the whole world really right now. It's starting to actually, put pressure on even the bigger economies like China. And then also in China, we talked about months and months ago the Evergrande situation with the real estate collapsing over there. That's starting to now come back full circle, where China has been running into some bank runs, actually, shutting people out of their banks and keeping them away from their money, which has started to, I guess, irritate a lot of the citizens, as you can imagine. But you also have Europe with their energy crisis that's going on, and everything that's going on with the war in Ukraine. That's not contributing, but did hear some news that there might be the pipeline might be reopening, so that would be good for Europe to get that gas back over there and in there. So pretty much that's it for this week. If you guys have any questions, or you want to talk about your specific situation, as how things could play out and how you should be reacting or setting yourself up, please feel free to reach out anytime. You can give me a call or shoot me an email or send me a text if you want. All my information is in the link in the description. Also, just wanted to make a quick announcement for any investors out there watching. I have run into a couple investment properties that do cash flow, even with a mortgage right now, which is very hard to find right now. So if you're interested and you want some more information on it, you can take a look at it. I'm happy to give you the addresses. Take a look and see if it's something you might be interested in. But you might be in competition with me, because I'm actually thinking about putting in an offer on one of them. We'll have to see how that works and plays out. But like I said, feel free to contact me. And I thank you guys again for staying to the end, and I'll see you next week. Well, that's it for this week. If you enjoyed this video, please hit that thumbs up button to let me know. And don't forget to check out the link in the description to get access to our MLS search engine and tons of free tools, resources, and hot lists. And if you ever want to connect or chat, my info is in the link as well. As always, stay safe, and I'll see you in the next video.